Market crashes can have a significant impact on businesses, investments, and the overall economy. While no one can predict them with absolute certainty, several economic indicators have historically signaled financial downturns. Understanding these warning signs can help investors and businesses prepare for potential risks. Here are the top 10 economic indicators that often precede market crashes. 1. Inverted yield curve. An inverted yield curve occurs when short-term interest rates become higher than long-term rates, signaling that investors are worried about future economic growth. This indicator has accurately predicted multiple recessions, including the 2008 financial crisis. 2. Rapid interest rate hikes. Central banks, such as the U.S. Federal Reserve, adjust interest rates to control inflation and economic growth. When rates increase too quickly, borrowing becomes expensive, slowing down business expansion and consumer spending, often leading to a market downturn. 3. Declining consumer confidence. Consumer confidence reflects people's optimism about the economy. A sharp decline suggests that consumers are cutting back on spending, which can slow economic growth and trigger a market correction. The Consumer Confidence Index, CCI, is a key metric to watch. 4. Rising unemployment rates. High unemployment indicates economic distress. When businesses start laying off workers, it reduces consumer spending, weakens demand, and can lead to a recession. A sudden spike in job losses is often a red flag. 5. Excessive stock market valuations. When stock prices are significantly higher than their historical averages, measured by the price-to-earnings ratio, it may indicate a market bubble. The dot-com bubble of the late 1990s and the 2008 financial crisis both featured excessively high stock valuations before collapsing. 6. Declining corporate earnings. When companies start reporting lower profits, it signals economic trouble ahead. Falling earnings often lead to lower stock prices and reduced investor confidence, which can accelerate a market downturn. 7. Surging inflation. High inflation reduces the purchasing power of consumers and increases business costs. If inflation rises too quickly and central banks fail to control it, economic instability can follow, leading to a market decline. 8. Decreasing manufacturing activity. Manufacturing output is a strong indicator of economic health. When production slows, it often signals reduced consumer demand and weaker economic growth. The Purchasing Managers' Index, PMI, tracks this data and is closely watched by analysts. 9. High levels of corporate and consumer debt. Excessive borrowing can create financial instability. If businesses and consumers take on too much debt, they may struggle to repay loans, leading to defaults and financial crises, similar to what happened during the 2008 mortgage crisis. 10. Sharp declines in housing market activity. A slowdown in home sales, rising mortgage defaults, and declining home prices can indicate broader economic problems. The 2008 financial crisis was largely triggered by a housing market collapse, making this an important factor to monitor. Recognizing these economic indicators can help investors and businesses prepare for potential market downturns. While no single indicator guarantees a crash, paying attention to these warning signs can improve financial decision-making and risk management.